as we talk about the aftershock economy, what are the implications for investors as they think about this over the next 5 years? And how can they build resilient portfolios and take advantage of the opportunities that present themselves?
And I think one of the aftershocks we're going to see in response to this massive tightening in policy rates, this very, very high inflation, will be some challenges in those areas where people were reaching for yield. But we still believe neutral rates are low. May not be as low as they were back with our new neutral research several years ago, but still relatively in a low range. Maybe 0.5% higher or so, but generally on the lower end of the range from a long-term historical perspective. Secondly, we've had a massive repricing. We haven't seen these nominal yields or real yields since back pre-global financial crisis, and we think that global sustainable growth rates are lower today. So we think there's tremendous value there as well. Lots of near-term uncertainty, lots of ongoing uncertainty around inflation, around risks of harder landing. But in the higher quality areas of the bond market, very, very solid return potential on a go-forward basis.
So moving to markets, over the past year, we've seen massive changes in central bank policy rates, as we've been talking about. How does this impact various regions, including both developed and emerging markets from your point of view?
Yeah, so one of the key conclusions is that we're coming out of a period of, relatively low variability in business cycles, a period of significant volatility suppression from global policymakers, an environment of more global interrelated markets, to one where we expect cycles to be much less consistent with one another. That could create some challenges, but it's great for active asset management. It's great for more flexible global mandates. It's great to be able to flex between public and private markets. So we do think one of the characteristics of the next few years will be certainly more geopolitical uncertainty, but also much less synchronized cycles, much less ability for policymakers to suppress volatility.
So Dan, there's a lot of factors on the balance in the mix on corporate credit. What are our views on credit markets over the next 5 years?
Today's investment grade and traditional high yield market are much higher credit in terms of overall credit quality than they have been in the past, particularly the high yield corporate credit market, where you have a higher average rating, lower leverage. A lot of that excess lending over the last decade migrating into the senior secured loan space and into the private credit markets. The IG and the high yield market are primarily fixed rate markets where companies were able to lock in record low rates during that 2020 and 2021 period. Household credit is rock solid because so many households were able to lock in record low mortgage rates over this period as well. So we think, given the uncertainty on the economic side near term, the high risk of recession, we think you should inherently stay up in quality. That means investment grade credit, consumer credit, securitized credit, when you can get additional protection in the form of subordination, hard collateral, better documentation. We think the high yield market looks reasonable given the higher quality setup. We are concerned more in the senior secured loan space. These prices have reset lower, but this is an entirely floating rate market. There's tremendous growth in this market back when investors saw very, very low front-end rates and didn't expect them to go materially higher from where they were.
Let's maybe turn to the commercial real estate market. What is your outlook for that sector?
The last few decades have seen a much tighter relationship between the capital markets and real estate valuations. We are going to see some significant upcoming maturities. There's certain sectors of the commercial real estate market that are facing longer-term headwinds. Retail, which has been the case for now many, many years. The office space, which is one of these areas where there was a shorter-term shock associated with COVID, which is becoming a secular challenge in terms of shifts in workplace preferences, worker preferences. There are going to be continued challenges in those areas of the market. But when you step back and you look at residential real estate segments of the commercial real estate markets, multifamily, new housing development, residential for rent type strategies, industrial strategies, data centers, which are nearly perfectly positioned for this new technological revolution that we're experiencing. Here you have a situation where these sectors need to adjust to the higher rate reality. They're going to be performing properties that just have a bad cap structure that need to be addressed. But these will be manageable, and they're, again, going to create tremendous, relatively low-risk opportunities for new capital in that area of the market.
So if we zoom out, public and private markets, PIMCO has a unique vantage point given our capabilities across this spectrum. Any other thoughts on various fixed income sectors that you want to add?
So where we are today, we believe you should focus on areas of the market that have widened as interest rates have gone higher, but that do have inherent resiliency. Later on in our secular outlook, we think there'll be a time to pivot to some of the public opportunities in the more economically sensitive or lower rated areas of the corporate credit markets, and then pivot into the private markets as they finally begin to reflect true fundamentals. We're more constructive on interest rates over the long run, but for investors that want more defensive characteristics in their portfolio in terms of interest rate risk, you can be resilient, you can be defensive, you could have shorter maturities and still generate returns in that high single-digit range. One area of the market we didn't talk about much today are agency mortgages. A sector that's been attractive during the peak COVID crisis, back in the first quarter of 2020. Now, of course, the central bank's reducing balance sheet, and banks are less active in this sector. So that's probably the best example of a high-quality asset, a bit more complex than a typical treasury bond or a typical corporate bond, that's offering tremendous yield right now because of this fixed income volatility, which is elevated and very well may be trending lower even as equity volatility increases over the course of the next few years.